Today, I want to talk about how Citadel is currently in big trouble, as they've been paying massive fines to avoid delivering shares because they cannot locate them. I want to talk about how the SEC and the Fed is actually allowing this to happen and is even aiding Citadel in their avoidance. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Mr. David Neo tweeted saying the clock has started ticking fast. He said, don't look at what they want you to look at the whole picture. And you'll soon understand that somebody out there is currently swimming naked. He said everything out there with Citadel right now is currently hanging by a piece of thread. Out of the $57 billion worth of securities that Citadel holds, 54 billion of those are currently pledged as collateral. So Citadel is currently pledged like 96 or 97% of their securities as collateral and only has around 3 or 4% currently unpledged. That means that Citadel is currently only around 3 or 4% of their portfolio away from a margin call. We can see that Citadel has $57 billion of securities owned at fair value, but this screenshot here also says that approximately $54.59 billion of those securities have been pledged as collateral to counterparties on contract terms, which permit the counterparties to sell or repledge these securities to others. Basically, Citadel has pledged practically all of their assets as securities in their margin loans. And obviously, if they do get margin called, that allows those counterparties to effectively sell Citadel securities or close out of their short positions. We knew that Citadel have taken on massive margin loans, and actually what we now know is that Citadel is very close to that margin call. They're not 10 or 20% away, they're literally 3 or 4 percentage points away. And as G-Man tweeted, he said that in 2022, Citadel Securities also paid $7.75 billion to brokers for not delivering securities shown in customer accounts. Their year-end balance of amounts payable to custodians for unsettled trades is $7.75 billion. Now, this technically doesn't show exactly how much was paid during the year to these custodians for unsettled trades, it just shows the outstanding year-end balance. Citadel could have already paid $7 billion in fines and still has another $7.75 billion to go. So therefore, technically, we don't know exactly how much Citadel has already paid in fines, but we know they still have $7.75 billion left. And as G-Man tweeted, he said those shares in your brokerage account, yeah, those are likely synthetics. But don't worry because they need to buy all of them back. Every last one. This goes to show that Citadel actually has a massive portion of their overall portfolio currently hidden in these unsettled trades. For a fund that only has $57.5 billion for securities, to be owing $7.75 billion of those in unsettled trades is a massive portion. Considering that trades with the DTCC take 2 days to clear, technically a fund should only have 2/365ths of their portfolio as uncleared. So that's something like 0.6% of their entire portfolio as uncleared, unsettled trades because of the time it takes for trades to settle. But in actual fact, Citadel has well over 0.6% of their portfolio as uncleared because this number here is actually well over 10%. And that really goes to show that Citadel is purposefully not delivering these shares and is purposefully paying these amounts for their unsettled trades. So it's kind of crazy that Citadel is not only purposefully paying these amounts to purposefully not deliver shares, but it's also crazy they're paying over $7 billion, well over 10% of their portfolio, in these unsettled trade fees. I think this really shows that Citadel has a massive problem right now because they've already pledged over 95% of their portfolio for their margin loans and also have a massive amount of uncleared, unsettled trades. And as 741 Trade tweeted, he said Citadel paying nearly $8 billion a year not to deliver can only mean one thing, and it's because these shares are undeliverable. Now obviously these shares are undeliverable because in fact they're not real shares, they're simply IOUs and synthetic shares. And therefore Citadel will have to continue paying these undeliverable fees because those shares won't ever be delivered because they're not even real shares. Effectively, Citadel's fund is just going to continue dwindling down until they've pledged all of their assets as collateral and until they receive that margin call and forced liquidation. But it seems like the SEC and potentially the Fed as well is actually trying to aid Citadel with their avoidance on delivering these fake shares. Also guys, be sure to join me over on Moon with a sponsor of today's video using the link in the description below. You can currently get up to 17 free shares, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomoo is very easy to use and is very clear to use as well. They've also got tons of technical indicators and advanced charting tools. And with Moomoo, you've also got free 24/7 customer support, and you can also trade around the clock with full extended global hours. And obviously with Moomoo, they also offer options trading as well. As 741 Trade tweeted, he said the CBOE has filed an immediately effective rule change to amend order execution or routing for orders involving Regulation SHO securities. This effectively allows market makers to post short sales on Regulation SHO securities away to a separate trading centre. They've basically said the short sale transaction under Regulation SHO won't be eligible for routing to the CBOE exchange, but it can be routed away to a separate trading centre or a separate exchange, maybe a dark pool for example. Now Boki asked if this is good or bad, but as 741 Trade tweeted, he said you can pretty much assume that anything immediately effective is not in favour for retail investors. It effectively means that CBOE is making a desperate change with immediate effect to obviously help out these market makers and these broker dealers. And as Frank Castle tweeted, he said, oh look, they're amending or making a new backdoor to the rules because the other 12 backdoors they've already made are now dead ends. Obviously, these short sellers and these market makers have been trying desperately to escape their AMC and GameStop short positions using so many different tactics over the last year or two. We've obviously had those FTDs being hidden in the options chain, we've had those married and divorced puts, we've had those total return swaps, and we've also had the unlimited creation and unlimited shorting and unlimited borrowing of shares through those FTX synthetics. But obviously over the last year and a half, we've been finding out about every single one of their backdoors and effectively closing their backdoors for them. But it now seems they're even having to recruit the exchanges themselves to help create new backdoors for these short sellers to try and escape. But ultimately we know that our shares are not for sale at these low prices, and therefore these short sellers cannot close out their short positions and cannot escape their liabilities. This also ties in with what Crystal Ball is thinking, who tweeted saying GNS sure popped up at a convenient time to suck volume away from AMC for a couple of weeks. He said they were riding the coattails of 2 years of our work on naked shorting with some claims of a task force, but look at it now. GNS has obviously fallen from their highs over the last couple of weeks and is now down, I think, in total around 50% from the peak. On top of that, nobody really seems to be talking or tweeting about GNS anymore, and there's been no further update on their short selling investigation task force. It seems that GNS was potentially just trying to benefit and ride the wave to pump up their stock price before issuing new shares. But obviously what it did do is potentially suck volume away from AMC, so those short sellers could try and push the price down on AMC a bit more and try all they could to bankrupt the company. But obviously once again it didn't work, and that's why Citadel right now are in so much trouble and really don't have an escape route. And now finally you may remember that I spoke about Blackstone a few weeks ago because they had limited withdrawals on one of their huge property funds. But now it seems that things are getting even worse for Blackstone as they've now defaulted on a $562 million bond backed by Finnish offices and stores. Not only were Blackstone not profitable in their huge property fund, not only did they try and restrict withdrawals so the fund didn't lose too much, but they've now been margin called on their loan. Things obviously got so bad that they couldn't afford the interest payments, and they've now missed the interest payments and have therefore defaulted on that giant bond. And as Gold Telegraph tweeted, they said this is actually the world's largest private equity firm that's defaulting on massive loans. If Blackstone are defaulting on massive giant loans, I don't think it's going to be long until even market makers like Citadel are also defaulting on their loans as well. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.